Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures lower this morning after the worst stock sell-off this year. All of the U.S. major averages closed down by more than 2%. NASDAQ 100 fell 4% in its biggest one-day drop since 2022, now down 12% from its all-time high. Sharp sell-off coming amid growing concerns on the street of a growth slowdown as investors grapple with slowing economic growth and tariffs from the Trump administration.
Plus, on the sector front, investors rushed into defensive corners of the market. The technology sector was the hardest hit, along with consumer discretionary, which are seen as more risk-prone and especially amid a weaker economy. Meanwhile, sectors seen as havens amid economic woes were stronger. Sectors like utilities and energy, the best performers amid the sell-off.
And looking at the individual market movers, Tesla shares falling 15% in their biggest one-day slide in 5 years amid growing concerns on Wall Street about demand for the company's electric cars. Meantime, corporate America sending warning signals. Mixed picture for airlines, which initially fell after Delta slashed its outlook on economic uncertainty, while United Air said it's seen weakness in travel demand. Stock futures still in the red this morning after U.S. stocks saw their worst day of the year in Monday's trade, with tech stocks bearing the brunt of losses and the NASDAQ seeing its biggest intraday slide since 2022 amid a growing wall of worry. Joining us now with more, we've got Tony Wang, T. Rowe Price Science Technology Equity Strategy Portfolio Manager. Tony, great to have you on this morning. I think the big question for investors is, especially with tech and the valuation concerns that we've seen during the run-up in these AI names, is this a buying opportunity? At what point is this a buyable dip in tech stocks?
Yeah, I think that's the key question right now. I think that when you look at it, there are signs where we should stabilize and there will be rallies, and the technicals do suggest that we rally back. But I think that when you take a step back and look at the last few years, tech has had a really good run. Growth and momentum stocks have done extremely well. And when you think about the Mag 7 leading, they've kind of gone to Lag 7 in this year. And I think that's part of it is because they were spending a lot of CapEx, and then the results are becoming more in line. And, if we look forward, they're likely going to be not accelerating. So I think that when you think about kind of the setup here, while there are suggestions that perhaps these valuations are a lot more attractive, I think that you have to know what kind of market you're in. If you're in a bull market, you need conviction. And if you're in a bear market, you need some patience.
And so all this considered, Tony, we had on the show yesterday Mohamed El-Arian, who had given us some context about what to expect over the course of this year. And he said a bumpy journey with a growth scare. What does that translate through to the portfolio strategy that investors would be apt to employ?
Yeah, well, so, I think that we want to be understanding in terms of what the market is kind of set up. And so where are there, in my opinion, fundamentals that are improving, that valuations are very reasonable. I think here we see the valuations have been repriced in the last few months, but I think that if you go to conferences, a lot of the sentiment is nothing's changed, right? The fundamentals are still strong, numbers are still good. I think you can read that as it's bullish or it's bearish because numbers have not reset yet and there isn't real capitulation.
So what exactly should investors be looking at when it comes to that capitulation moving forward here? What would be the potential catalyst to get stocks moving back up into the green?
Yeah, I think that it all does come down to fundamentals being sustainable. I think that right now the growth scare is that, what happens in 2026? We're seeing some cracks. I think that this morning, Delta Airlines as well as Asana reported softer macro. Is this a blip? And how do people think about the go forward on 26 being more of sustainable numbers where it's not going to be dramatic fall off?
And this is a earnings period where we typically see some of those full year forecasts kind of revised and giving the markets a sense of ultimately what they should expect for the rest of the year so that companies might have the opportunity to even beat on some of those expectations. But from some of the revisions that you've seen thus far, has the companies that have reported, the executives, have they clearly communicated whether or not the worst is actually baked into that, or could there be potential downside potential here still to some of the earnings projections that we've seen?
Yeah, I think if you look back at this last earnings cycle, they're actually like relatively good earnings and beats, and they were kind of met with relatively muted reactions, or even the stock sold off. And so when companies report good results and the stocks go down, it's actually like a pretty concerning thing. And investors started wondering, like, are we just past the peak cycle, and where the investors in the market are looking more towards things being a little bit more half empty. And so I think that was a combination of strong results met with like lukewarm or kind of downside in the stocks. And so here I think that you want to look at like where are there areas in the market where it's not over earning, and what stocks probably didn't do particularly well in the last 2 years that could have a more resurgence. And so I think that that's kind of what we're looking at in our fund.
But what does that say about the forecasts that they're also putting out there too? Because if you do have that type of reaction, the markets typically on average are looking 6 months out. So it's clearly something about what these companies are saying that's getting baked into their guidance.
Yeah, absolutely. And so if you look at, one thing that was kind of interesting is that the Stargate news came out and the stocks didn't move up very much on that. That's an example. And so, I think that the forecasts are, here, but I think that a lot of times, like, the market, it doesn't believe it right now. And so it's essentially discounting it and saying, like, this is not sustainable, the numbers are too high when they're getting sold off. And so, that's the controversy where we're going to have the bull bear debate. And I think that the next few quarters are going to really matter here.
Yeah, Tony, forgive me. Do you talk names, individual stocks?
I think we can talk some names at high level.
Okay,
I could give a long-term perspective.
So of the Mag 7, obviously in correction territory, now down 16% year to date, which of those names is best positioned for recovery?
Yeah, I think that if you think about, follow this framework of where returns going to improve and where can they accelerate, I think that you probably have Apple being the one that's been out of the CapEx war and like chasing frontier models. And so if the models do become more commoditized, and whether it's like DeepSeek or more smaller models that are able to generate more ROI for enterprises, I think if that plays out, then I do think Apple is a good position where they haven't spent a lot of CapEx and they're still the ecosystem holder. And if there's an upgrade cycle because of that on their iPhones, that they can essentially do a little bit better relative as a result.
I'm still the problem for Apple right now, Tony. I still got this 12 Pro Max right now. The battery is just fine, and I guess the only thing is I don't get all the benefits of apps that are now fully over to that iOS 17. That's a me problem, and somewhat of them problem too. Tony, thanks so much for taking the time.
Thank you.
Well, U.S. stock futures this morning, they are mixed now, with the NASDAQ flat just barely to the upside. We'll see where that holds going into the start of today's trade. The market's meltdown, though, to begin the week coincides with a major shift on Wall Street as strategists rethink the growth outlook for the U.S. economy. Here to discuss this further, we've got Josh Schaefer. Josh, one particular takeout from Citi here, especially kind of leaning into this right now as well.
Yeah, so Citi's global team was out this morning, Brad, saying that they are moving to a neutral stance on U.S. equities. They actually moved China to an overweight. You've seen this kind of move across a lot of different firms as far as moving something overseas to overweight and moving U.S. equities to neutral. What you're looking at on your screen right now is GDP forecast. Those are from Goldman Sachs and Morgan Stanley. JP Morgan also moved theirs down. And again, notably, Goldman Sachs and JP Morgan moving down their U.S. forecast, moving up their Euro forecasts. You take a look at the stock market over the last month, what's been going up, Euro stocks, what's been going down, U.S. stocks. So sort of what's happening here is a little bit of a play to a rate of change, right? You want to be in the area where things are going up, not in the area where things are going down from a growth perspective. And as we see these economic growth forecasts get moved down for the U.S. economy, that has not been the trend over the last year. So we're counter to sort of where we had been. And what I think is important to point out here, I want to highlight this chart from Lori Calvasina over at RBC Capital Markets. It's a look at GDP and how stocks interact under different GDP regimes. What's interesting in this chart is between 0 and 2% is when you see stocks fall the most. not when GDP is below 0%. So what is that chart showing us? I would argue it's showing you that the most dangerous time in the market is when the market is pricing in a slowdown, right? Not when the market is, when we've already accepted that we're in a slowdown. Right now, we're starting to price in a little bit of a slowdown. We've moved below that 2% level where stocks normally perform well. And the question is, how far down are we going? And quite frankly, I don't think anyone has that exact answer right now. As we always joke, if we did have that exact answer, we'd probably be trading right now, right? But I think that's the key question right now, right? Is you're pricing in a slowdown in growth, how bad is the slowdown going to be?
That's such an important chart. It points to the need for certainty in the market. And Josh, I found this chart this morning that I want to get your take on here, just to give our viewers a sense of what might happen today, the day after a drop like we saw coming into the start of this week on Monday. The majority of the time, you do see the market recovering. The following day, you can see a gain of about 1% is going to happen the majority of the time. But of course, there is still a chance that we continue to see selling, and nobody knows where we're going to go from here. What are you looking at? What are your sources looking at to determine just over the course of today, over the course of this week, when we get this key economic data on inflation, where are we going to go from here?
Yeah, Maddie, I think there's two cuts to that chart too, right? The other one would be I could look at the top and the bottom line, which tell me move more than 1% or move less than 1%. That's also over a 50% chance too, right?
Yeah.
So in some ways, perhaps the volatility that you've seen in this market isn't going anywhere.
That's the only guarantee.
And that, I think, is sort of what most strategists are saying right now. Listen, this is not maybe the dip that you buy hand over fist this morning because we feel confident that this narrative is changing right now. Yeah. It is a little bit of a wait and see. You have inflation data coming out tomorrow. You have consumer sentiment data on Friday that has been moving the market over its last couple of releases. So there doesn't feel like a clear catalyst where you're going to say, okay, now I know it's time to buy, right? And I think that's important for investors out there to understand too, is when you talk about quote unquote buying the dip, no one knows exactly where the dip is, right? And at some point, things just start to slowly change a little bit, and there will be some catalysts along the way. But just because we had the worst day in the stock market since 2022, at least from the NASDAQ's perspective, that doesn't mean that you just get a relief rally today and then it's over after that relief rally, right? I think some of these growth concerns that are out there are legitimate. I think the policy uncertainty is, of course, not leaving us, right? We still don't know what's happening with tariffs in a month. Yeah. That conversation isn't going anywhere. So I don't think this is we're going to leave this week with more answers than we had. We're out of peak earnings season right now, right? We're hearing from some airliners today, but you're not hearing from a lot of corporates right now either. So it's a little bit of a quiet period. We're sort of digesting, trying to figure out what's happening. Again, key inflation data tomorrow seems to probably be your next major catalyst.
The honors physics student in me would say even dead cats bounce. Ultimately,
that is true.
That is still true. Josh, thanks so much for taking the time. Recession fears are creeping into the market as investors attempt to understand the administration's ever-changing trade policy and its potential impact on inflation. The market will get its next gauge on the state of the U.S. inflation Wednesday with February's consumer price index. Joining me now, we've got Julia Coronado, who's the Macro Policy Perspectives founder and president. Thanks so much for taking the time here with us today. Let's just start with your expectations for this next inflation reading that we're set to get this week.
Yeah, I mean, we expect that we're going to see some remaining stickiness, the kind of stickiness we've seen in recent reports. Not quite as bad. We expect some progress in core inflation relative to January, but we're at a 0.3. We get maybe a tick of relief on the annual rate, but really this isn't a report that's going to give a lot of relief to the Fed. We're in a period of beginning of year price resets that tends to keep core inflation a bit elevated in Q1. So we still think we're going to see some of that in the February report. And so that kind of leaves the Fed in the holding pattern it's been in. And just waiting to see how these policies that are very likely going to affect the trajectory of inflation and growth unfold in coming months.
Julia, what does it take, in your view, to get the Fed to really firmly put itself back on the table when it comes to the idea of the Fed put? What does it take for the Fed to come out and be more dovish? We know that the market is pricing in over 80 basis points of cuts so far this year, increasing the chances of a cut in May. How much more pain do we need to see for that cut in May to become a reality, in your view?
I think we need to see more pain. So the Fed is in a very difficult position. The policies being proposed are almost certainly going to lift consumer prices. So they're not going to see the progress that they had expected to see in the near future. That leaves them on the sidelines unless and until the economy really breaks, the labor market really softens decisively. The bar to cutting is a lot higher than it was, say, in the last trade war in 2018, when inflation was running below their target. And so as tariffs disrupted the global manufacturing economy, the Fed could take out a few insurance rate cuts just to make sure that that doesn't infect the US economy. We are not in that position. The Fed is approaching its inflation target from above. Inflation has been sticky in recent months. So it really would be, the next cut is likely to be motivated by labor market weakness. And it has to be, worrisome enough that they're willing to overlook the imminent threat from tariffs on inflation. So they're looking at risks to both sides of their mandates. And I think May feels real early for them to be lowering rates.
Do you think that prompts them or forces them then, if they see more weakening than they're anticipating on the employment situation side, and then perhaps some adverse effects on the inflation side due to tariffs or any policy action, that puts them in a position where they have to make a decision that they weren't prepared to make or forecasted to make coming into this year?
You mean in terms of, could they raise interest rates?
Potentially.
That has been a conversation we've had with some of our clients. I think that's less of a likelihood now that we see the economy really starting to show strains from what I'm calling the uncertainty tax. It's not just around trade policy, but every facet of policy, including Social Security. So there's a lot of elements of uncertainty that both consumers and businesses are facing. That is starting to show through to the soft data and even into the hard data. Again, it's pretty early, but the direction of travel seems clear. Given that trajectory, we've already been below the GDP forecast you were citing. We came in the year at 1.6, expecting a slowing trajectory on trade wars and restricted immigration. We're getting more earlier than we expected. Really, the wild card here has been the chaos and the DOGE sort of defaults on government contracts and this payment disruptions and large scale firings that really have injected uncertainty across a range of sectors that really hadn't been expecting that. And so given the growth scare, the likelihood of a rate hike seems very low.
And Julia, to that end, I want to bring up a quote we have from the White House yesterday. It is an official saying, we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from business and business leaders. So the White House saying, hey, we're hearing from corporate executives that things aren't that bad. And then later on that same day, you hear from Delta Airlines lowering their profit guidance, hearing similar commentary from small businesses in the small business survey this morning, and also from the likes of Verizon. Are we seeing signs of the beginning of a corporate America slowdown in this economy?
Absolutely. What they're doing, you're hearing a lot of sort of damage control and spinning out of the policy officials that have produced this uncertainty. But when we look at measures of business sentiment, when we talk to business executives, when we scrape earnings reports and see what companies are talking about, it is not a growth-friendly environment. And so you can call it detox or however you want to frame it in a positive light. This is a tough environment for companies to make hiring decisions, to make CapEx decisions, to plan for the future. A lot of the actions we're seeing were not the ones we expected going in. Yes, we expected tariffs on China. We did not expect a trade war with Canada and Mexico. These are our biggest trading partners. This is significant for U.S. businesses. So, and unfortunately, we don't see any clarity in sight. It seems like we're still going after our neighbors, and that's starting to affect travel. We hear people canceling plans to come visit the United States. That's going to affect education, students' willingness to come study here. There's a range of sectors that are going to be impacted by this that, again, weren't the ones that we were really focused on starting at the start of the year.
All right, Julia, really wonderful breakdown. Thank you for joining us. We hope you'll come back soon.
My pleasure.
Coming up on the morning brief, we count you down to the opening bell on Wall Street. Plus, we'll break down the outlook for airlines as Delta and United warn of weakness to come. We'll also dig into Oracle's earnings and what they say about software and the AI sector. We'll discuss all of that and more on Morning Brief ahead.
Shares of Delta Airlines falling after the company slashed its outlook amid economic uncertainty and weakening travel demand. The airline is not alone in slashing its forecast, as United came out today saying it's also seeing weakness in travel demand. Joining us now, we've got good friend of the show, Stephen Trent, Citi analyst and managing director. Steve, good to have you back here with us. You have a buy rating on Delta and an $80 price target. Now, I know for legal reasons, OGC, there are probably a lot of considerations before you come and say to us that this would prompt you to revise your targets. But is that a conversation that you're having with your team about where you're kind of looking across the airline landscape and trying to figure out how to bake that into even what are your top picks within this industry?
Yeah, morning, and thank you for having me on. I think in terms of the long-term outlook, there's not a great deal of impetus to go and make big moves in any investment cases for this group. I think over the short term, there's a huge amount of noise. We have DOGE cuts, the DOGE impact on government employment and government travel. There's uncertainty about tariffs. And at the same time we've had all of this, we've had several high-profile aviation accidents since the beginning of February, and some natural phenomena to deal with, such as the wildfires out on the West Coast. So on a short-term basis, the move we've seen has been extremely aggressive in terms of share price action. I don't necessarily think that changes the long-term view, but certainly over the short term, what we end up doing in 1Q in terms of our expectations could at least partially determine what nuances we make on long-term estimates. But I don't see any of this leading us to suddenly have an entirely different thesis on the group.
So, Steve, I want to get into how it might impact your long-term thesis, but I'm viewing this through the lens of something Ed Bastian told us in January. He said supply-demand balance is as good as I can ever recall it being. We are just 2 months away from him saying that. Something shifted very quickly. What exactly was it, and does it weigh on the long-term thesis for Delta?
Yeah, absolutely. So I think in terms of what shifted, I would say you've actually had some government level decisions, for example, on tariff policy, and that stuff is way above my pay grade. And you've also unfortunately had the aviation accidents that I mentioned and some natural phenomena. But I think what Ed was getting at in terms of the group's discipline is important. Look, we had early last summer concerns about domestic capacity, that there was too much supply in there. And that's something that, as we shifted to the third quarter of last year, ended up getting corrected rather quickly. So that is an important shift versus how the group has responded to this over the last 25 years. Do you have these kind of self-help opportunities today? Can we see some pivots in capacity over the next several months? I would certainly not rule that out.
What would you be watching for, Steve, just within the mind of the consumer? We're going to be getting a lot of inflation data over the course of this week that gives us really an eye into how consumers are thinking about everything from the goods purchases that they're making all the way through the services that they're buying into and the experience economy tied up within that too. What would you be watching for within how the consumer is putting some of those dollars to work within experiences that could then translate to how the airlines are really communicating and continuing to be in coordination with how they can welcome in consumers, knowing the pricing that they're navigating through at a household level right now?
Yeah, absolutely. So I think the main piece of the pie that looks like it's under pressure at the moment is the U.S. domestic market, and in particular, domestic leisure. So we've already had some consumer data that has been less sanguine, and that's certainly something that's already been flowing through in these 1Q guides. So if we see more of the same, I think that's going to some degree, act as a barometer for what kind of domestic demand we can see over the next couple of months. And I think on top of that, does the group cut? Do they start revising capacity downwards as they did last year? So that's certainly an arrow in the quiver that hasn't been exercised yet, but I think that's something important to watch.
All right, Steve, thanks so much for joining us this morning. Appreciate it.
No, pleasure. Thank you.
When we return, we're going to bring you the opening bell on Wall Street. You're still looking at stocks moving to the downside with the NASDAQ hovering above. That is your opening bell on Wall Street. Let's get a check on the markets here. Taking a look at futures as we wait a second for the market to open on our end here. You're still looking at pressure, though we're just around the flat line here when it comes to the trade. We're actually seeing a little bit of recovery in the tech-heavy NASDAQ earlier this morning, so it'll be interesting to see if we do continue to get that throughout the trade today. Again, we're still waiting for those markets to open here on our boards for us. If you take a look at the 2-day chart, you can see just the degree of selling that we have seen in that tech-heavy NASDAQ here. You take a look at your S&P 500 opening down just about 0.2%. You can also see that struggle when it comes to the S&P 500. And here you can see just how much we are off of our all-time high, down nearly 10% from that all-time high in your S&P 500 here. But I do want to just flip the board over really quickly and take a look at some individual stocks when it comes to the market. If I can get our board behind me to load up here, you're still looking at selling across the board. Interestingly, Microsoft hovering around the flat line. What's interesting about them is they are the cheapest stock in the Mag 7, I believe, at the moment when it comes to their PE ratio. Meta here, the only member of the Mag 7 that is not down year to date. So that's been interesting to monitor. And Amazon also looking relatively affordable given the sell-off that we've seen. Interesting to see Nvidia moving to the upside right now as we are in the market open here. If that continues, could that lead to gains in the market today? Apple's still seeing a sell-off after the biggest sell-off, I believe, for that name since August. So again, interesting to see. And even Tesla recovering today after its biggest sell-off in nearly 5 years, I believe. So interesting to see some of these individual movers of the Mag 7 recovering after that degree of sell-off. Will that lead the NASDAQ to continue to be in the green throughout the day? We're going to get into all of it and more with Yahoo Finance's Jared Blickery for a broader look at what's moving in markets. Hey, Jared.
Well, thank you, Maddie. I want to go back to the indices, and specifically I'm looking at the S&P 500, which lost $1.4 trillion yesterday. I like this 6-month chart. I'm going to extend it to 1 year. And one of the things I'm seeing right now is the prior highs from last year in July and August, September. Those highs are now kind of yielding to price. So price has dipped below those. And we want to see that recover pretty quickly here. Otherwise, it suggests that we're in for some more downside. So combined with some of the other indices kind of approaching or going through to the downside, their major levels, it just kind of doesn't necessarily bode well for the market, although it is still possible to get a sharp snapback. And if we are still in this bull market, that's exactly what I would expect right here. If we have another steep down day, that is kind of off the table. Also want to note that small caps are leading right now to the downside. They're down, well, not getting that quote. Let's look at the S&P 600, leading to the upside here, up about 0.25%. And that's after a pretty steep loss yesterday. But the small caps didn't lose as much as the large caps. And we're going to look at the sector action here. Energy, materials, and real estate in the green, while communication services and staples down more than 0.5%, but not really seeing any big outsized movements. And this screen right here, the NASDAQ 100, pretty different picture than we were seeing yesterday. One thing I liked about Apple's movement yesterday was that it stopped right at the 200-day moving average. Unfortunately, and that would be right here. Unfortunately, it's trading below that, and it is now testing support, the 2025 lows. So we'll have to see if Apple can sustain its levels that it's been holding here. Do want to get to Chinese stocks. Those have been jumping. Those have been a bright spot in the market recently. But futures, something interesting in futures caught my eye this morning. That would be coffee. KC equals F is kind of coiling for a move. It's down today, but this formation here, this is a year to date. I'm going to put a 5-year chart on. It's just kind of camping out near these highs, and given the recent run up, I think it's going to be potentially a bellwether for some other action commodities here. Going to leave you on Bitcoin. Bitcoin bounced off its 200-day moving average. So a lot of 200-day moving averages in play here. I'll put a year-to-date from that 5-year, and you can see just getting a little bit of a bounce there. My target still remains 70 to 72,000 for Bitcoin, though. Brad?
All right, we're going to be watching very closely to see if we strike that target. Jared, appreciate it. It's time now for today's strategy session. Investors are grappling with the biggest market sell-off of the year, with several Wall Street strategists souring on U.S. stocks. Citigroup strategists downgraded their view on U.S. stocks to neutral from overweight, citing expected negative U.S. data prints and uncertainty over tariffs and government job cuts. So how should you position your portfolio? Joining us now, we've got Anthony Saglimbini, who is the Ameriprise Financial Chief Market Strategist. Great to have you here with us this morning. First and foremost, as you think about some of the changes in position that we've seen, even from that of Citi to kind of muted on the U.S. exceptionalism trade that really kind of rattled through and was the consensus on the street, how is that shifting your own strategy right now?
Yeah, thanks for having me. The last couple of weeks have been very difficult for investors from an equity perspective. Yesterday was obviously a very difficult day. You saw Mag 7 collectively move into a bear market. You've seen the NASDAQ move into a correction. You've talked about some of the technicals. A lot of the major indexes violated their longer-term 200-day moving averages. And I think a lot of it is the market reaction to some of the tariff uncertainty we're seeing from the White House. So the market, I think, is making a judgment that these tariffs, and in the degree that they're being discussed, is likely bad for profits and it's likely bad for the economy. We haven't seen that translate into economic data, but coming into this year, the U.S. economy was on firm footing. We just got the employment data last week, created 151,000 jobs in the U.S. economy. Unemployment's low. Consumers continue to spend. We'll see how that plays out in the first quarter. But the profit situation for U.S. companies was very strong in the fourth quarter. And even though those outlooks have come in over the reporting season, analysts still expect the S&P 500 to earn around 7.5%, which is still a pretty strong earnings number. So our view is there's likely to be volatility in U.S. equities for the, probably the near to intermediate term. But our fundamental view on the U.S. economy and U.S. markets still remains solid.
So if your view remains solid, then at what point in this dip do you see and tell investors to get back in, to utilize the dip as a buying opportunity?
Yeah, that's the question everybody's asking, right, from an investor standpoint. And it's very difficult in the moment to kind of determine where the buying opportunity lies. But when you start talking about an S&P 500 getting close to correction territory, trading below its 200-day moving average, the NASDAQ composite moving down around 14% from its all-time high, longer term, those are typically good buying opportunities if the U.S. economy doesn't move into a recession and corporate profitability remains on track. A lot of questions about how tariffs are going to interact and interplay with those dynamics. But generally, from a longer term perspective, investors probably want to be putting their shopping lists together. They want to be looking at equities if they have cash, excess cash on the sidelines. One of the things that we've been telling our clients and advisors is have a plan for addressing the volatility. Right now, a well-diversified portfolio of stocks, bonds, cash, alternatives is helping insulate some of the risks in equities today. And longer term, there will be opportunities that are created in some of the secular leaders. You guys just touched on some of the Mag 7 names that have seen a tremendous amount of pressure over the last couple of weeks. These are the secular leaders in the U.S. economy. And at some point, their valuations will become low enough where investors will look at these opportunities and those valuations and look at their growth rates and maybe put some money to work. And so I think over the next few weeks, the market's going to be volatile. It's going to be very headline driven by the tariffs. But as long as profitability remains solid for U.S. companies and we don't see a deterioration in the economy, this type of volatility historically is a buying opportunity for investors longer term.
And so I guess the larger question, and one that we brought up earlier on in the show, and as Maddie had raised, is what is that catalyst? Because it's more than just, hey, there's a massive dip or massive pullback here, buy in and hope for the run back up, because of course over time we all know markets tend to go higher. But it's that time horizon that investors would have to be banking on to make sure that their time in the market is valuable enough and that there's catalysts that emerge on the other side of that. And so is it clear right now where those catalysts will be? Because a lot of the Mag 7 names that had really been kind of encapsulated within an AI trade have now seen their own retracement, which sends the larger question of, should people buy further into those names or should they go into the safe havens like they typically do at a time like this?
Yeah, you're absolutely right. And it all depends on your time horizon. I think over the next few months, the investing environment is going to be difficult. And so having, appropriate levels of cash and fixed income and alternatives can help blunt the volatility in a portfolio. Obviously, more defensive sectors of the S&P 500, like staples and healthcare and utilities, can help blunt some of that volatility. And you're right, you need a catalyst to help reshape the market sentiment, which is quite negative right now. And so I think some of those catalysts will include more announcements on tariffs. I mean, like I said earlier, I think the market is clearly sending a signal to the White House that these tariffs are bad for growth and bad for the market. If we see the White House back off some of these more extreme tariff rates, then I think that could be a catalyst to move the market higher. And then obviously the earnings season in April and May will be a big indication of where investors feel confident about putting money into the market.
All right, Anthony, got to leave it there. Thanks so much for joining us. As we head to break, let's get a quick check in on crypto. Bitcoin and Ether moving still this morning to the downside, but coming back slightly after Bitcoin hit a 4-month low. You're also seeing a big recovery in the tech names. You got your NASDAQ up about 0.5%. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Oracle missing third quarter earnings estimates and issuing a disappointing forecast for the current quarter. Still, the company expects its cloud infrastructure business to boost revenue over the next 2 fiscal years. Joining us now with more, we've got Rishi Jaluria. He is RBC Capital Markets MD of Software. Rishi, you also lowered your price target for Oracle to $145 from $165 following the results. What's the problem here?
Yeah, and thanks so much for having me. Look, I think it was overall a pretty mixed quarter. As you correctly pointed out, they missed their own guide on Q3. Their Q4 guidance was implied to be a little bit lighter than expected as well. You couple that with strong backlog growth, which was expected. We can get into the puts and takes there. But really my concern is the sustainability of some of this growth, right? That they've signaled they're also seeing capacity constraints. They're taking longer to get data centers online than expected. And really, I think, in spite of the stronger than expected growth that we're seeing out of OCI, which is their competitor to AWS and to Microsoft Azure, in spite of that, a lot of that success, I think, has some temporary or non-sustainable growth drivers, including selling of excess capacity to some of those companies, right? To Microsoft, to Meta, to Cohere, to others. And that's why we felt kind of coming out of this, not surprised to see the pullback in the stock this morning.
Rishi, it's particularly interesting for companies like Oracle, companies like SAP and ServiceNow that are in this basket of recurring revenue and looking at some of where they're continuing to see their customers have a propensity to spend or even raise some of the seats that they're willing to pay for, plus the added deal scrutiny in this cycle, because this gives us a read through to how CEOs and executive management teams really feel about their business prospects right now in their comfort to spend in some of the technology that they utilize on a daily basis. I wonder what your read-through is as assessed through Oracle's results.
Yeah, no, and I think you're spot on, right? If we can put the results on these and other enterprise software players, we're almost the way through earnings season. That is absolutely it, right? Like you are seeing more deal scrutiny. We've been in a tough software macro environment for now 2 years, where it's not getting worse, but it's not getting better, and there is deal scrutiny, especially for large deals. There's consistent optimization of spending and headcount, and now maybe we have some even broader macro concerns. Even if software is kind of viewed as being a little bit more stable, or at least tariff proof, the fact is all the noise that we're seeing in the broader economy is creating uncertainty. It is leading to longer sales cycles. It is leading to deprioritization of certain investments. So absolutely, I think that's a right read through to take from this.
What about just the demand picture when it comes to AI specifically, which is a huge sticking point with the market? What is that? What are Oracle's earnings telling you about that demand picture?
I think it's telling us a couple of things, and I think look, the overall demand picture for AI is still super strong. When I'm talking to CIOs and talking to companies, really there is appetite to invest in AI, but increasingly the messaging has shifted more towards faster payback periods, higher ROI, cost savings, margin expansion, rather than kind of the long-term AI story, which I think will still play out. For Oracle, what it is telling us is there still is AI demand. In fact, they've told us one of the issues they had is their capacity constraint, and that's part of the reason for the miss in the softer Q4 guide, is they just don't have enough capacity to meet demand. And by the way, this is consistent with what Microsoft has told us, is consistent with OpenAI has told us. A number of, I think Amazon has said the same thing. There's just more demand than there's actual capacity, and capacity is not just GPUs, right? It's things like liquid cooling, it's power, it's physical space. So the demand signals are still very much there.
Rishi, always a pleasure to grab some time with you. Thanks so much for joining us here on Yahoo Finance.
Thank you.
Another trending ticker we're watching, shares of Tesla regaining some ground so far this morning. That's after experiencing its worst day since 2020, with its price sinking to levels not seen since October of last year. UBS cut its price target for the stock, expecting Tesla deliveries to fall by 5% year over year due to softer demand. Meanwhile, Morgan Stanley analysts suggesting investors buy the dip. President Trump promising on Truth Social to buy a brand new Tesla as a show of support for Elon Musk. There you're seeing the post on Truth Social saying that the radical left lunatics are trying to illegally and collusively boycott Tesla, one of the world's greatest automakers and Elon's quote-unquote baby. First and foremost, we should note that in a free market, there's no such thing as an illegal boycott because consumers can purchase whatever they want. That aside, for Tesla and the annexation that Elon Musk has selectively made to cozy up to Trump, that was a decision that he made as well. So all of these things considered, investors and consumers, they also have their own decision about how close they want their trade to be tied to the Trump team in the administration. And then additionally, for consumers, they also get to decide whether they want an electric vehicle. And oh yeah, by the way, for the electric vehicle purchasers out there, more of them typically lean left, which is interesting if Trump is trying to bolster more purchases for Musk, because most of those purchasers of his supporters are really more ICE, internal combustion engine owners out there.
It's just interesting. I mean, with Tesla, the story is twofold, right? Obviously, there is concern about consumers switching away, to your point, Brad, from the brand here, but also you have concerns about the broader slump in sales and whether or not the lack of availability of additional models is something that's going to continue to weigh on shares moving forward. We're consistently seeing their competitors beating them out, especially abroad in places like Europe and China. And you've got the stock recovering today, but only after the biggest sell-off in 5 years. So certainly a stock that we're going to continue to monitor. But want to switch the board over here and looking at Kohl's. Shares plunging more than 15% in trading this morning. Kohl's anticipating a larger than expected drop in comp sales for 2025. For the three biggest takeaways from the retailer's cautious outlook, we've got Yahoo Finance's own Brooke DePalma. And Brooke, just the latest retailer to issue a cautious outlook. What stood out to you?
Absolutely. This is yet another retailer to really spark a concern that we're going to experience this weaker consumer in 2025 that's going to take a toll on their sales. So let's talk about that cautious outlook. The company, or rather executives on the call this morning, said that cautious outlook includes time needed to make necessary changes and uncertainty in the macro environment. Now, with that cautious outlook in mind, same-store sales are expected to drop between 4 to 6%. That was far lower than Wall Street's estimates. Earnings also expected to come in lower. And once again, executives saying that this is taking into consideration the turnaround, which the CEO says is very achievable. But he also added that it is going to take time. Now, keep in mind, Ashley Buchanan is a former Michaels company CEO. That's the art and craft store. He joined the company in January on 15th, so roughly 2 months ago. But prior to Ashley's tenure at Michaels, he held a variety of senior executive roles at Walmart and Sam's Club for nearly 13 years. And he's certainly taking the helm here and making changes right away. Back in January when he joined, they announced plans to cut nearly 10% of their corporate workforce, and they also plan to close 27 underperforming stores by April. But leaning further into these focus areas is really this idea of assortment, value, and omni-channel. With that assortment in mind, the company did say that they expect to have a more balanced assortment. They plan to refocus attention on core categories that they said they really lost traction, including fine jewelry and proprietary brands, really focusing in on the need for value. Now, on the call, Ashley Buchanan did say from a macro perspective, you had a pretty decent bifurcation among income levels. He said that those making less than 50, that consumer is pretty constrained from a discretionary standpoint, and less than 100, he said that consumer is also facing some challenges. But he said that I don't think we're an anomaly on that. If we look back in recent weeks, we've heard from Macy's, Walmart, Target, also cautioning this weaker than expected guidance for 2025.
All right, Kohl's shares getting rocked right now, down 16%. Brooke, thanks so much for taking the time to break this down. Appreciate it. As we head to break, let's check in on the major averages, the Dow, the NASDAQ, and the S&P 500. Keeping tabs on them as they are mixed right now. The NASDAQ is up by about 0.8%. We'll round that off to the S&P 500 turning positive, flat just barely to the upside. The Dow still in negative territory by about 0.5%. We've got much more ahead on Morning Brief. Wall Street executives will convene at the White House today for a meeting between President Donald Trump and business executives amid uncertainty about wide-ranging tariffs and a market sell-off driven by recession fears. The meeting with the Washington-based Business Roundtable is set to include CEOs from across the country, including the bosses of Wall Street's biggest banks. What's going to be notable is what some of those leaders have to say. This comes just after companies from Apple, JP Morgan Chase, Walmart have already met with Trump in various forms. We've seen these CEOs already make their trips to Washington, D.C. even since and on the inauguration day to try and get the ear of the president. There you see OpenAI CEO Sam Altman, who was in the Oval Office. And as these different announcements have been made around some of the international investments that the U.S. is trying to welcome in, plus the different cozying up to some of these business leaders and those business leaders to the White House, that has been extremely noteworthy because of what they also are acknowledging that the downside could be if they don't have the ear of the president to investors.
Well, we saw this with automakers. They were able to make a deal with the president. They got what they wanted on tariffs. Will tech CEOs get the same thing? They were at the White House on Monday. Today, it's Jamie Dimon and Jane Fraser's turn. Interesting to see what headlines we'll get out of that in terms of any regulatory pressure that might be released from those big banks, especially amid the sell-off we're seeing in financials. But that's going to do it for the morning brief. You can stick around with me for the next hour for more markets coverage on Catalyst and be back for Brad the hour after that. He'll have you for wealth.